Despite multiple rate cuts from the Federal Reserve, inflation is on the rise again. What does this mean for 2025? If you're wondering how this will hit your wallet or investment portfolio, stay tuned, because the decisions made next year could shape your financial future. The Fed is caught in a balancing act, cutting rates to keep the economy moving, but risking inflation that's already hitting specific sectors. Used car prices up by 2.7% in a single month, rental costs still climbing, and energy bills swinging unpredictably. And with a new administration under Donald Trump, fiscal policies are about to get a shakeup. The stakes are high. For the average consumer, it's about keeping up with the rising costs, while investors are looking for the Fed's next move to anticipate shifts in the market. In this video, we'll break down what you can expect from inflation and the Fed's rate policies in 2025. We'll dive deep into what rising prices mean for everyday expenses like housing and energy, and explore how the Fed's cautious approach impacts everything from stocks to bonds. Will the Fed manage to cool inflation without stalling the economy, or are we in for a notey volatile year? Let's analyze what's ahead for both consumers and investors. The economic landscape post-election, inflation expectations, and the Fed's monetary policy. In 2025, the U.S. economy will be grappling with the direct consequences of policies from newly re-elected President Donald Trump. While inflation has shown signs of slowing after a turbulent period, Trump's approach may bring new challenges. His fiscal stimulus plans and tariff increases could push inflation up again, directly impacting consumer prices. How will the Fed, under Jerome Powell's leadership, respond to these pressures? Moreover, the Fed has signaled that interest rate cuts could be a reality in 2025 to ensure sustainable economic growth. The unknown is how far these rates can drop without triggering a new inflationary cycle. The balance between inflation and growth will be the starting point for many future decisions. For investors, this means navigating a scenario full of uncertainties, where the Fed's decisions and Trump's policies will have a direct impact on asset values and long-term returns. The impact on the cost of living. How consumers will be affected. With persistent inflation expectations, consumers in 2025 will face a steady increase in the cost of living. While inflation rates have dropped from 9.1% to 3.2% in recent months, prices will still be under pressure, especially in the energy and transportation sectors. The rising prices of used cars, for example, reflect residual inflation that may continue to affect consumers' wallets. Will the Fed be able to control these increases without harming purchasing power? Additionally, consumers will need to prepare for potential price hikes in essential services like rent and healthcare. Contained inflation is a real risk, as rental prices continue to rise, albeit more moderately. This phenomenon may place additional pressure on consumers, reducing their purchasing power and impacting their daily financial decisions. How can consumers adapt to this new reality? The relationship between inflation and interest rates. The Fed's role in 2025. In 2025, expectations for interest rate cuts are increasingly high. The Fed has room to act, with a forecasted reduction in rates to stimulate growth without worsening inflation. For investors, this may be seen as an opportunity, as lower rates could encourage more investment in stocks and real estate. However, this approach can be a double-edged sword, as prolonged loose monetary policy may intensify inflationary pressures in the future. The Fed's dilemma will be adjusting rates to a neutral level, where growth is sustained without generating more inflation. For investors, this means careful navigation. While lower rates can generate profits, an overly relaxed monetary policy could undermine long-term asset values. What should investors do to protect their portfolios and ensure continued growth without major risks on the horizon? How investors can navigate economic changes in 2025. 2025 will be a year of major challenges for investors, especially those with portfolios sensitive to interest rate fluctuations and inflation. The Fed's monetary policy and Trump's fiscal incentives may affect both stock and fixed income markets. With expectations of rate cuts, assets like real estate and bonds may benefit, but investors should remain alert to signs of new inflationary pressures. The risk will be balanced between immediate returns and long-term sustainability. One of the biggest concerns for investors will be the risk of persistent inflation, which can erode returns on more conservative assets. In 2025, The investment environment will be in constant flux, making it essential for investors to stay updated on the Fed's policies and changes in the political landscape. How will the Fed manage this risk, and what does it mean for long-term asset selection? Trump's political decisions will have a direct impact, but how should investors prepare for potential market volatility? Resilient inflation. The long journey of inflation in 2025. Although inflation numbers have decreased, the real impact on consumers and investors will still be felt in 2025. Suppressed inflation is a central concern, with higher prices in areas like rent, transportation, and food. This means that even with a cooling overall inflation rate, consumers and investors will still need to adapt to a high cost of living. The Fed, though attentive, may find it difficult to slow inflation without compromising economic stability. Over the long term, consumers will need to adjust to a prolonged inflationary cycle, with the Fed trying to balance its policies without triggering another wave of price increases. What will this mean for economic growth in 2025? For investors, this creates an uncertain environment where asset selection will be key to protecting capital. Additionally, Trump's strategy of stimulating growth through tariffs or other incentives could further worsen inflation, forcing the Fed to reverse its interest rate cuts. Labor market challenges. The impact of a low-interest economy. The economy of 2025 will also be marked by increased flexibility in the labor market, driven by interest rate cuts. With lower rates, companies may hire more workers, but this could also generate inflationary pressures due to increased demand for labor. In a scenario where the economy is growing, but inflation remains persistent, workers may face wage increases that, in practice, are eroded by rising prices. For consumers, this means an ongoing struggle for purchasing power. For investors, this context can create opportunities but also risks. With a heated labor market, companies may need to adjust their business models to cope with rising wage inflation, which could impact profits in the short term. On the other hand, a larger labor force could boost productivity, benefiting economic growth and, eventually, the stock market. How should investors adjust their expectations regarding sectors most affected by these labor market changes? The role of economic expectations in 2025. How the market reacts to uncertainty. In 2025, economic expectations will be shaped by a range of factors, from the Fed's monetary policy to Trump's political actions. The Fed's interest rate decisions will have an immediate impact on markets, but how consumers and investors react to economic uncertainty will be the most important factor. What will happen if the Fed continues to cut rates without fully controlling inflation? How will consumers adapt to an environment of high prices and low interest rates? For investors, this will be a decisive moment to make strategic decisions. The uncertain scenario may be challenging, but it can also open doors to opportunities in resilient and well-positioned sectors. If investors understand how prices may evolve and how the Fed will respond, they will be better prepared for success. Ultimately, the impact of decisions by Trump and the Fed will be felt differently, but with one common point. Both consumers and investors will need to stay vigilant to avoid losing control in a constantly changing market. If you found this video helpful, please give it a like, leave a comment with your thoughts, and don't forget to subscribe for more updates on the economy and investing. Thanks for watching.